Welcome, Nathan. Thank you so much for joining us here on the couch.
Thank you. Thanks for
We
having me.
really appreciate it. Why we wanted to get you into the studio with us today is there's just so much uncertainty around what's happening in the market, especially
Yeah,
from a lending perspective. And, what does the recent interest rate cut mean? And the election's over, what does that mean? And so on and so forth. I think for our viewers, it's really going to be really beneficial you tell us a little bit about you and the evolution of Nathan and your business and where you
sure.
came from. And yeah, so please.
Thank you. So my name is Nathan Kovatch. I am the owner and mortgage broker at Loan Locker. So I have been in the finance industry for 15 years. So I started out way back in the early days working in the credit assessment space in ANZ. Essentially, they're the people who review approve and decline applications for home loans, essentially. So you get to see hundreds of different scenarios and things like that. Then evolved into the lending space as a lender at a branch. From there, worked in different sort of head office roles in the corporate centre at ANZ, Commonwealth Bank, and Westpac. So more around like the home loan products, how they're designed, how policy is implemented when things change. And then after doing all of that, instead of working for a bank, I wanted to come out and open up Loan Locker because mortgage broking is all about helping people. And actually, instead of being an employee of a bank, where you work for the bank directly, you can only sell their products. You have so much more variety into actually helping people as a mortgage broker. So I wanted to put all of that expertise to good use and actually work for my clients instead. So
Look, I think it's fantastic. And I think it's testament to how well you do take care of your clients. Having that credit assessor background would be so advantageous for you as a broker because you understand the different lenders and their policy requirements when it comes to credit assessment.
mm,
And I think that's the biggest concern for a lot of first home buyers, people upsizing, downsizes is my loan going to get approved?
yep.
What are they looking for? And how can I ensure that I'm putting my best foot forward when I do go to make that application?
A lot of the conversations I have with people, they might not be ready yet, but then there are certain steps that they just need to tweak a few things, make sure that they are ready. So it might be something like when I'm looking at what they're wanting to do and we're sitting down and we're talking about their goals or what they're wanting to buy, a part of what I look at is what is the bank going to look at, and is what they've presented me going to be an issue or is it not going to be an issue? Because sometimes if you submit an application with things that a bank will challenge or have a hard time overcoming, it's very hard to come back from that. So making sure that you're having the conversation with the client and looking at what they're wanting to do and looking at the information they presented you and then submitting it in the right way makes a big difference.
Can I ask, and this is not in my little deck of cards here,
Yeah.
but what do you reckon separates a good broker from a great broker?
The biggest difference is understanding where to place a client, because as a broker you have so many different banks you can send a client to. Most brokers have a range of about 40 different lenders, but there's like 100 different lenders out in the market. So actually knowing where the client is best placed is probably the key thing, because if you're a broker and you have a high decline rate of clients getting declined, then that's going to create a bad reputation for yourself, and it's a bad customer experience or a client experience. So that is really important. So usually a broker wouldn't send a client to a bank to get declined. That's never what they would like to do. But sometimes if you overlook things or you don't know what you don't know, basically. So if you're sending a client and they don't get approved, then that's not a good thing. So
One of the things that I've learned along the way by working with many mortgage brokers is relationships is so key. Like, having relationships with people within the banks and
mhm.
knowing, that's also quite valuable.
Yeah, it is. It
Yeah.
is. And especially when things don't go to plan or when things are presented to you that are maybe really urgent, you really have to lean on those relationships to make sure that things are done in the most efficient way, knowing who are the team managers, speaking to the business development manager. So most banks have what it's called a business development manager, and that's usually you're in to the bank. So they're an employee that helps brokers specifically. That's their role. And you have to have a good relationship with that business development manager because they're the ones that can help connect you to the people inside the banks.
So why do people these days still go direct to the bank and not use a broker when there's so much choice out there for lenders? And like you said, it's knowing where to position people and, me not having those key relationships or understanding the policies of different banks. Why wouldn't I just go to a mortgage broker? Why do people still go to the bank?
I think that's a really good question. And I think it could be a combination of a few things. I think a lot of people believe that the bank that they bank with is honestly the best one for them because they've probably seen it when they may look at their parents, and their parents usually bank with a certain bank, and those parents will set their kids up with the same accounts, and then that will generally be the way that they operate. And I don't think it's until they go through an experience with a bank and they don't have a good experience is when they take a step back and they're like, oh, hang on a second, why hasn't worked out for me? I think it's more of just an education piece that needs to get out there. There's a lot more uptake now in people wanting to use brokers, which I think is really awesome. So it's starting to shift a lot more now. But I think that the key part is probably boils down to they believe that the bank that they bank with is the right one when it's not necessarily the
Yeah.
case.
No, I 100% agree with you. Thankfully, mortgage brokers are definitely sort of laying the land forward.
Yeah, for sure. Yeah,
Oh, right. Let's deep dive.
let's get into it.
How have recent interest rate changes affected the borrowing capacity here in New South Wales?
It essentially is a direct correlation to borrowing capacity to interest rates because the way that a bank will assess an application it relies on a few key things. It's one, your own financial position, but then the other part of it is what the interest rates are as well, because the way that you're able to prove that you can service the mortgage is based on the interest rate at the time, plus they add their own buffers on top of those rates.
Are those individual to the bank?
Yeah, so these buffers that they assess applicants on are individual to the bank. They're all very similar to a degree. It's usually, about 3-ish% above the normal base rate. However, the base rate for the banks are all different. They all offer different rates for different clients.
Is there a way to find out exactly which banks are offering what?
In terms of the buffer rates,
Yeah.
it's not something advertised out to the public. Only a broker would know those rates, or the bank itself that you approach would know.
Yeah, right. Another reason to use a broker then.
Exactly.
Because if it's discretionary, again, you don't know what you don't know. So your
Yep.
borrowing power it could look very different bank to bank.
Hmm. Yep.
And you're not going to know that because they're not advertising what that buffer looks like.
Totally. Yeah, you wouldn't know. When we talk about the interest rate decreases that are happening, let's say, for example, it's a 0.25% decrease, that could be anywhere between, 10,000 to maybe 18,000 more in borrowing capacity, depending on the applicant. Why there's that variance depends on the bank because the buffer rates are different.
Should buyers be waiting for rates to drop even further before entering the market?
So, in my opinion, I don't think so. When we hear that rates are starting to decrease, I find that it starts to change the buyer sentiment. And I think for a long time, the last 2 years, the sentiment has been we don't know what's going to happen with rates. Rates are at an all time high, and people get nervous and they're a little bit more guarded. They may hold off buying and they may not hold off those aspirations of getting into the property market. So, when the narrative starts to change and interest rates start to come down, and we've already seen online the predictions of the banks and the economists are all bringing out, that we're going to have a few rate cuts potentially this year, and I think that changes the sentiment. So I always say if you can afford to get into the property market at the rate that we are experiencing at the moment, then now should be the time that you think about going into the market. Because if you can afford it now, you're affording it on the higher rates at the moment. And then if the rates do start to come down, then you're only just going to keep on coming into a better and better position with managing those mortgage repayments. And you'll probably end up being able to pay that loan off faster because as rates drop, if you keep the payments the same at the higher rate, you're going to be ending up paying off more
Mm.
on the home loan. So it actually helps you get ahead.
No, absolutely. And I think from our perspective, we get asked that question on the buying side a lot.
Mm.
I'm just going to wait for rates to drop. And it's like, great, but everyone else is doing the same. And competition is what inflates pricing a lot of the time. So you might
Totally.
be waiting for the rates, and they, like you said, all the economists are predicting that we will see a couple.
Yep.
Consumer confidence will continue to kind of get stronger. And then you're competing
Yep.
against, so many more other buyers for the same opportunity.
Yeah.
So,
Totally. Like you might have ten buyers
yeah,
at one open, but when rates start to drop two or three more times, you might have 20 people for
100%.
that same house that you're
Yeah.
looking at. So
Yeah. Okay, this question I like a lot. Which lenders are currently offering the most competitive rates and why?
interesting things with lenders. A lot of the majors, for example, have very big budgets with their marketing and advertising and all of those kinds of things. So you will see a lot of the rates advertised at some very flashy rates. And the interesting thing that sits behind the interest rates is that not everybody qualifies for those rates that they're advertising, and it's all about getting people into the door. And so once they've got them on the phone or got them in front of them, then they're trying win
Mm.
them on
Yeah,
on that
sell
business.
you the product that you're not eligible for.
Yeah, exactly, exactly.
Yeah.
Or say, we unfortunately can't give you this rate, but we
Yeah.
can offer you this. And then
Right.
they'll try and retain them because the way that interest rates are priced in Australia is on what your loan to value ratio is.
Mhm.
So, you know, from what you owe on the mortgage versus what they think the house is worth, and also how much you're borrowing. So it's a combination of the two, depending on where you sit in that realm is what they'll give you as an interest rate. So I always say, the banks that are giving the best rates are the ones that you actually qualify for and the ones that you fit within their policy. So if you fit in their policy and you're able to get the borrowing capacity you need and you're not being overcharged with fees or insurance or anything like that on top of the mortgage, then they're probably the banks that are the best ones for you.
Yeah. I appreciate will change as new policies are introduced to the market.
Yeah.
But are there any banks out there that you feel are just really sort of leading the way in terms of service, best sort of products available to the market, or is it really individualized?
It is really individualized in a sense that there are some lenders that I have seen that aren't investing as much in their technology as others. So, what's been really good to see is that a lot of people in Australia love offset accounts.
Mm.
Right. So a lot of people want to take advantage of using offset accounts, but for a long time, there was only a handful of lenders that would allow you to have one offset account. And that can be really challenging for a lot of people because we all want to manage our money in different ways. If you've got a partner, they've got their own bank accounts. Not everyone has one joint bank account, towards a loan, or you might do the barefoot investing and have multiple different
Yeah.
accounts for a holiday
I've
fund
tried that
or
once.
yeah.
Like all the buckets got too overwhelming for me.
Yeah.
Yeah.
And so it made it really hard just having one offset account because if you've got money piled away somewhere else, then it's not working as hard enough for you.
Right.
But a lot of banks have now switched to having multiple offset accounts, which is awesome because that means you can take advantage of having all of your money in different accounts and between two different people, and it's all linked to that one loan and helping to offset that.
So explain to the people listening to this, what is an offset account?
The simplest way to think about an offset account is like your everyday savings account that you would have where your pay goes into and you've got a debit card attached to it. So essentially, that's the way an offset account will look and feel to you on an everyday level. But what happens to that offset account is that it has a linkage to your loan, whatever you've got stored in that savings account. So say it's, $50,000 in that account and you've got a $400,000 loan, then it will be talking to the home loan and you'll be charged on 350,000. So the interest will be charged on 350,000. That way it's actually helping you save the interest on that home loan. So every time your mortgage payment comes out, there's less going towards the principal charge because it thinks the loan is lower than what it is, but your principal still stays the same. So you end up actually paying the loan off faster that way by having an offset account.
Does every bank offer offset account options or
Most banks have offset account options. If they don't have an offset account option, then they offer redraw.
and what does that entail?
So a redraw facility is actually built inside the loan. So the only way that you can reduce the interest charges other than making your normal repayments is to pay directly into the loan itself. And so the money will sit inside the loan in its redraw facility. And to get that money out, you would have to actually log into your online banking and then move it out from the loan into your
Right.
account instead.
Yeah.
So there are pros and cons for using a redraw or an offset account. And that comes down to, a few things, whether you actually want to pay that loan down, because if you're more of an investor type person and you want to maximize how much interest you're charged, potentially don't want to pay money off the loan. Or if you own a home that you might convert into an investment property, you might not want to put money in the redraw. You might want to have it in the offset account initially, for tax purposes, because you
Yeah.
don't want to pay the loan down.
How do you stay up to date with the rapidly changing lending policies? Are they
Yeah,
really boring to read?
sorry.
Are they boring to read?
The updates.
Yeah.
I'm such a nerd.
Oh, I
Like, really, I'm such a home loan nerd. And I think it's just because of my background, but
Yeah.
I love reading the.
Oh, really?
Yeah, so I get a lot of so we get updates in all sorts of
Yeah.
places. I read a lot of the articles
Yeah.
online because I subscribe to a lot of them and I get them in my inbox. So
Yeah.
usually in the quieter parts of the morning,
Yeah.
I'll read them. But the best way to actually keep ahead is speaking to the point of contact you have for the bank,
Mm.
because a lot of the times they will be fed updates that haven't been released yet. So, like, I usually have regular coffee catch ups, just like I would with business partner or anything like that. I do the same with the banks. And in those conversations, you're just asking them, what are you seeing happening? Like, what have you seen being approved that you didn't think would be approved? So that's probably the key thing I use to keep ahead, because it's easy to find out more information when you're sitting in front of somebody or if you're on the phone to somebody.
How do you approach fixed versus variable rates in the current economic climate?
Fixed versus variable is an interesting one at the moment because the fixed rates have come down a lot. There are some that are about 5.19%, 5.35, and a variable is more high fives at the moment. And so, to an average consumer that doesn't know the ins and outs of a bank, you'd look at the fixed rate and be like, oh, of course, I'll go for that fixed rate because it's heaps lower. I always look at what's happened in the past when I'm thinking about fixed rates and variable rates. And at this point in time, it reminds me about early on in my career, like in the 2010s when we had the GFC just finished and we were kind of coming back from that. And fixed rates were really attractive back then because they were lower than the variable. But then what happened was the RBA realized that they had rates very high for so long and they had to start cutting them really quickly. And they cut and cut and cut. And the variable rate ended up catching up to the fixed rate. In my opinion, I feel like that's where we might be at the moment. So whenever I'm looking at fixed rates and variable rates with a client, I let them know that the fixed rate is going to be what it is for that time that you've locked it in for. And the banks are kind of like Monopoly. They don't like to lose. So,
Yeah.
they don't want to lose.
Yeah.
So
Yeah.
if they're locking you in for a rate for 2 years at a particular rate, they're thinking that the rate's either going to be at that rate by the end of the 2 years or it's going to be less than that on a variable after that. So they're
Yeah.
hoping to make that extra bit out of you. So if you want a fixed rate at the moment, you've really got to be a person that just wants absolute certainty in your monthly repayments, and you are happy in the fact that if rates do go down, that you're okay with the fact that you might be on a slightly higher rate because that fixed repayment is something that you're comfortable with.
Let's just say you're on a variable. Does it automatically change when the interest rates drop, or do you have to speak to your broker or your lender and say, "Bring my loan down. The
Yeah.
rates are dropping."
Yeah, it actually depends on the bank.
Ah,
So
okay.
every bank has a different approach with when they drop rates, if once they're announced. And so we haven't seen it yet because rates have only just started to fall down. However, when the RBA announce that they've dropped the rates, banks can choose whether they pass on the full amount or whether they only pass on a certain amount. And
So what's the point of an interest rate cut?
yeah, I know, right?
Guys, it's all a lie. Biggest scam ever.
Yeah, I know. So it's just like when rates go up, like
Yeah.
they've all been very quick to align with the RBA. But historically, when we saw rate cuts happen, back in the 2010s, not all banks actually dropped at the same amount. They might have dropped point 0.10 instead of 0.25, and that is also an interesting thing that plays a part in choosing a bank as well. But with actually asking the bank, can you recalculate my repayments on a rate cut? Back to that initial question that you asked, every bank is a little bit different. So some banks will drop your rate automatically, but what they won't do is automatically drop your repayment. So some banks will keep it at the same amount that you've currently paid, which means, you might be paying more off your loan than you once were because you're still paying the old minimum repayment on the old rate, but your interest rate has dropped. Some banks will drop your minimum repayment even if you didn't want it to. So then you would have to, manually go in and change your repayments.
So it would be like, is your role to reach out to all of your clients when there's an interest rate cut and just say, in this case, we need to go and speak to the lender? Or
With my clients, the ones that are paying extra, I know what banks increase and decrease the minimum repayments as opposed to the ones that will keep them at the same. So for the clients that I know that are wanting to pay extra, I'll let them know. I'll send them an email and be like, hey, rates are going to be cut, and just make sure you've checked your repayments, and if you do want to keep them, you just have to update that on your banking portal.
what strategies can help clients to reduce their interest burden over time?
This is an interesting question. And I think the way that I would say there's a few things that you can do to cut your interest burden. I have a bit of a story to tell around a client that I've helped. It all starts with how you set up your loan initially. So I've had these clients of mine recently, like literally a few months ago, and they were looking to buy a property at around 1.5 million to about 1.8 million. That was their sort of budget. Before they came and spoke to me, they went to the bank that they banked with because that's where they had their current mortgage. And their bank said, oh, that's fine with your deposit. We can do what you want, but we will charge you about $25,000 of lender's mortgage insurance on top of your loan, because they only had, for the top bracket, they only had about a 15% deposit once you pay for the stamp duty and take into account everything else.
Transaction costs, yeah.
Exactly. And they're like, oh, okay. And then they got referred to me. And so I had a chat with them. We figured out a bit of a plan. And I actually placed them with a lender that didn't charge lenders mortgage insurance for a 15% deposit. So what this lender does instead is they actually charge a slightly different interest rate, but there's no lender's mortgage insurance at all. And so a part of this client's goals was to renovate the property a little bit and make a little bit of money from equity and that kind of thing. So I placed them with this bank and ended up saving them $25,000 off their home loan.
Straight away.
Straight away.
Mm.
That's why it's so important in the very first instance. Buying a house is the most expensive decision you're ever going to make in your life. So you've got to get the structure right from the very beginning, because that initial change from them going to their original bank to what I offered them saved them 25K, which, that's more than what you'd probably pay off on the first year of the mortgage anyway. And so they ended up actually doing a bit of work. And now we're talking about refinancing them again to another bank because their valuation has come in higher and now they're sitting under 80%.
Yeah.
And so they've avoided that $25,000 completely. And so one thing is getting the strategy right from the beginning, because saving $25,000 off your home loan from the get-go is obviously going to save a lot of interest, because over time that interest accumulates and compounds, and that 25K is not just 25 grand.
And it could take people a long time to save 25 grand.
Yeah, they do. The second thing is, depending on your situation, utilizing the offset accounts. Now, once you have a home loan, there's really no need to have high interest savings accounts anymore, because high interest savings accounts attract interest because you're earning interest, whereas offset accounts actually save you interest, and it's based on the rate that your home loan is, which is usually about 5 to 6% at the moment.
And could you just use that for everyday spending?
The offset accounts,
Yeah.
you can.
How do lenders assess living expenses in today's high inflation environment?
Every lender has a different base level of living expense that they will calculate for an application. And the way that living expenses are designed is they're meant to be the bare minimum for a person to live day to day. And that's made up of how much income you earn as either a single applicant or as a joint applicant, how many children you have or how many dependent children you have, and sometimes your postcode and what area you live in.
Cheeky, I hate it when they do that.
Yeah. So,
It's so annoying.
yeah, it is.
I'm just going to put my postcode as like the poorest suburb in Sydney moving forward.
Yeah. So, there's a few things that go into how they calculate that baseline.
Yeah.
And it can be a little bit tricky for some people because, yes, it's meant to be the bare minimum. But sometimes, like I've had a few applicants who are, have a lot of their expenses covered for them. They might have an allowance for transport, or they might have a motor vehicle allowance, or they might be fly in and fly out, and they don't actually spend a lot. But that minimum has to stay in place for assessment purposes.
Oh, really?
And yeah, so that's why when you may have seen a broker show you, what you can borrow with all the different banks, a part of the reason why some borrowing capacities are higher at some and lower at the other is because of that minimum living expenses, along with other things like their lending policy on income and stuff like that.
See, that's interesting because you would think that your goal is to try and keep your expenses low so you look like a more desirable applicant. But
Mm.
that's not necessarily the case because they have minimum requirements anyway for living.
Yeah, they have minimum requirements anyway, but also I guess it's still important to like prepare your accounts before you go for an application, because if you are over, sometimes in certain categories, that might be hard to justify in an application depending on what you want to do.
What would you think would be something a bank would look at as like a red flag?
So it depends on the LVR, because
Okay.
an LMI application will look differently to
Yes.
an 80% application. But things that flag things that are a little bit of a red flag are definitely cash withdrawals and gambling,
Mm.
excessive gambling.
Oh, excessive
Yeah.
gambling.
So if you're buying a lottery ticket,
Yeah.
once every so often, we all do it. I hope I win, 50 million on the Tats Lotto. Assessors are humans too. They understand that we
Yeah.
do these things,
Yeah.
but
We're all hopeful we're going to win lotto.
exactly.
Yeah.
But things like excessive gambling are red flags.
What about Uber Eats?
Uber Eats comes under what I like to say is discretionary. They're things that if you're renting at the moment, you might have more Uber Eats days or weekends than you would when you own a home, because your objectives are different at that time. So they will understand that those things can be pared back.
And what about things like payday lenders like Afterpay and Zip Pay and things like that?
Yeah, I've actually done a few things on my social media about that, because there's Zip Pay and Afterpay are a little bit different to each other. So Zip Pay, they will do a credit check on and you'll have a credit inquiry on your file, whereas Afterpay currently don't do that. When we talk about the bank's policies, some lenders will look at Zip and Afterpay exactly the same. They'll treat it like a credit card and they will expense it at the limit that you've got available. Some banks, with Afterpay specifically, they will include it as a part of your living expenses instead of a credit limit,
Because there's no credit check attached to
because
it.
there's no credit check attached to it, and it's more like a buy now pay later type thing.
And what about HEX?
Yep.
And let's say outstanding tax debt. I don't know if you can talk about this here, but do banks, will they not lend to you if you have those two things, or will it just reduce your borrowing capacity?
Hex does reduce your borrowing capacity. There are new policies that have come in place specifically with CBA, where if you have a HEX debt that's nearing the end of its term, so if you've got like a couple of years left, then they will potentially exclude it from your borrowing capacity, which is an awesome thing, because HEX is a huge thing that reduces people's borrowing capacity,
Mhm.
and a lot of people have a HEX debt. But with HEX as well, it also depends on how much income you earn as well. So if you are earning underneath that threshold of where you don't need to pay for HEX, I mean, at the moment it's like 55,000. I think next year it's somewhere in the 60,000 income bracket. Say one of you is on a high income and the other person has a HEX debt, but is under that threshold, then some banks won't expense your HEX debt. With tax debt, that one's a bit of a tricky one because that comes down specifically to the lender itself because they have different policies on how they treat tax debt. So that one, yeah, is a little bit of a
That's
case by
okay.
case.
Tell us all the answers
Yeah.
now. Give us tax advice. No. Okay, beautiful. What can clients do to increase their borrowing capacity before applying? We've touched on this a little bit, but
Yeah. So, I mean, one of the things to do is obviously pay off debt. So, reduce the amount of debt that you have before applying for a loan. If you know that you want to buy a house, don't go and buy a new car and put a lease on that car because that's going to decrease your borrowing capacity. So, what I like to say is if you're thinking about getting into the property market, have a conversation with a broker first because they'll at least tell you what you need to do and what those steps that you need to take to improve your borrowing capacity. Because sometimes I talk to clients and they might not be ready for, a year or 2 years, but at least they kind of now have a plan to be like, right, I need to pay off this car loan. And then once this car loan's gone, then I'm going to be able to achieve X.
what type of loan structures do you recommend for first home buyers versus investors right now?
I work with a lot of first home buyers in my business, actually. It's one of the things that I specialize in. The thing with first home buyers is that the banks don't really have a first home buyer option. I guess it's all about, the right loan for them. It all comes down to what they're able to qualify for. So the structure has to meet their goals now in the current environment, and then also be able to give them the flexibility to do what they want to do in the future if they do have plans.
And what about investors?
Investors, it depends on your strategy. So some investors like to have their structure in a, you might have heard like with your clients, they're wanting to put it in, buy it in under a trust
Mm.
or under a company. And that can be good for certain investors. So that's one way to go about investing because under the trust and company structure, you can preserve your borrowing capacity as opposed to having it in your individual name. Because under your individual name, when you have a loan, it's your liability and you are personally liable for it. But under a company structure, that loan is technically under the company name and it's a company liability. You still need to prove that that company can service that loan and everything like that, but it's not yours directly. So that's why investors sometimes like to have it under that structure as opposed to their personal. But having it under that structure also has different implications when it comes to selling it later down the track as opposed to having it in your personal name. So
Yeah, it's always like,
there's always a
yeah,
trade-off. It's just
always
which
a
one is the
trade-off.
best, which one's the
And
right one.
well, not unfortunately, but I think it's just so important to like have a really good team around you in that regard, like a good accountant, a good planner, a good broker, like everyone speaking to each other. I remember when I went for my first loan, and my planner was speaking to my accountant who was speaking to my broker, and they were all working in the background for me to work out what was going to be the best structure based on my current situation.
Yeah.
And they all had all of the information that the other person didn't have. So
Yeah.
I think if you are looking to buy a property or upsize or downside, just make sure you have a good financial team supporting you in the background.
Absolutely.
Yeah,
Yeah.
because I had no idea what I was doing, and the stuff they were asking me for, I was like, oh, like, why you need that?
Yeah, yeah. And with a broker, we generally ask for a lot more documents than you
Yeah,
would going to a bank
yeah,
because we're looking at multiple different banks
yeah,
and they ask for different things.
yeah,
So
yeah.
yeah, yeah, it can be very overwhelming. But a team, you got to have the A team.
Yeah, you gotta have the A team.
Yeah,
Same when buying a property, it's very
absolutely.
critical. I have a Courtney-proof team
Yeah,
around me.
you
But
need it.
no, thank you so much for coming. I
Thank
think
you.
this has been super helpful, not just for Kelly and I, but I think for anyone listening as well. Like
Yeah.
I said, you don't know what you don't know, and policies are changing every day. Banks, there's a lot of hidden information, if that's the right way of framing it.
Mm,
That unless you go looking for it, you're not really going to know. So you're just going to be put pigeonholed into a product that might not necessarily be the right one for you. And
Totally.
unfortunately, you really want to try and get it right from the beginning when you
Yep.
set it all up. And that's the scary part, is you can't necessarily pivot along the way.
Yeah, yeah, yeah.
So
You can't DIY your
yeah,
finances. Well,
exactly.
you can,
You
but
can. Yeah.
there are
Yeah.
cons, pros and cons.
Exactly. Anyway, thank you so much, Nathan from
Thank
Loan
you.
Locker. If anyone's looking for a broker, I really hope they reach out to you.
Thank you.
Have a conversation today.